So now that we understand how monetary policy works, that is how changing the money supply changes interest rates and how that impacts investment spending and aggregate demand, we should look at the goals of monetary policy. So what would you use monetary policy for? Well, there are different goals for monetary policy, and there are different schools of thought as to when and where monetary policy is appropriate. So it depends on what goal you're trying to achieve and what school of thought you subscribe to. So there are the Monetarists and the Keynesians. We talked about those in the previous video. And we want to add a third, which is how Canadians typically use monetary policy. Okay, so when it comes to the goals of monetary policy, you can use it to create steady growth. You can use it to create an exchange rate that's advantageous to trade. You can use it to make sure prices are stable, not too much inflation, not too much deflation. You can also use monetary policy to achieve full employment. That is, have no cyclical unemployment. And anytime you have those business cycles, what you're doing is you're helping to smooth those out by getting rid of the gaps, expansionary gaps, contractionary gaps. Well, steady growth in GDP is what monetarists use monetary policy for. Using monetary policy to achieve full employment is what modern Keynesians use monetary policy for. Now remember, John Maynard Keynes himself was not an advocate for monetary policy, but today's Keynes do use monetary policy combined with fiscal policy, although they are much greater advocates for fiscal policy than monetary policy. And the last two goals, that of an exchange rate that's advantageous to trade and to have stable prices, these are the primary goals of Canada's monetary policy. So in this video, we're going to look at how do these different schools of thought use monetary policy to achieve these goals. So let's start first with the Keynesian approach. So Keynesian monetary policy is all about closing the gaps. So let's take a look at these two graphs. Let's start with the one on the left. The one on the left we see here is equilibrium, where aggregate demand and aggregate supply intersect. So this is the size of our economy. And we compare that to our potential GDP. So notice the size of our economy is greater than our long-run aggregate supply or our potential GDP. So right now the economy is bigger than its potential, or bigger than where it should be in the long run. So what type of gap do we have? If this is where we actually are, and this is where our potential is. Well, if actual is more than potential, then we have what type of gap? We have an expansionary gap. So then the question is, how do we close that gap? Because Keynesians use monetary policy to close the gaps. Well, monetary policy is money supply and interest rates. And we know that changing the money supply and interest rates changes aggregate demand. So we need a monetary policy that will decrease aggregate demand so that we can get back to our potential. So now we got to think of how do we get aggregate demand to decrease? Do we increase the money supply or decrease the money supply? Well, let's walk through it. What if we decrease the money supply? Then we're using contractionary monetary policy. And we know that if we decrease the money supply, what happens to interest rates? Okay, that's when you can go back and think back to your graph. Let's just draw a little one here. Here's money supply, here's money demanded. If you decrease the money supply, then interest rates do what? They go up, right? We go from here to here, interest rates go up. And when interest rates go up, what happens to investment spending? It gets more expensive for businesses to borrow, so investment spending goes down, which causes aggregate demand to go down, the prices to go down, and real GDP to decrease. So then we end up back at potential GDP, and we have closed the gap. So contractionary monetary policy decreases the money supply, so we take money out of circulation, or we raise the target reserve ratio, or we raise the bank rate and the overnight target rate. Any of those would make interest rates go up, investment spending to go down, aggregate demand to decrease, and we're essentially slowing down the economy, making prices fall so that we get rid of that expansionary gap, that too much inflation, the economy growing too fast. Well, what if you're the scenario that's on the right? So here's equilibrium. So this is the actual size of our economy. Here's potential. So in this case, potential is more than our actual. And if potential is more than our actual, we have a recessionary gap. So we need to figure out how to close that recessionary gap. Well, changing money supply and interest rates changes aggregate demand. So to close this gap, we need aggregate demand to increase. So how do we get aggregate demand to increase? Well, if we increase the money supply, that's an expansionary monetary policy. And if this is money supplied and here's money demanded, we increase the money supply. What does that do to interest rates? Well, if we increase the money supply at the current interest rate, we now have a surplus, more money than we want to spend, and so we're going to move our cash into bonds and other investments, and that's going to make interest rates go down. When interest rates go down, it's now cheaper for businesses to borrow, so investment spending goes up. And when investment spending goes up, that's more spending. Aggregate expenditures are C plus I plus G plus X minus IM, so aggregate demand goes up, which means prices go up, and our real GDP increases. So if you have a recessionary gap, you can increase the money supply and lower interest rates to make the economy grow and make prices increase. So Keynesian monetary policy is about closing the gaps. So you got to be able to identify what type of gap you have and which monetary policy is appropriate for it. Contractionary monetary policy closes expansionary gaps. Expansionary monetary policy closes recessionary gaps. We want the policy to move the economy in the opposite direction of the gap. Now, there's some challenges with monetary policy and the Keynesian goals of closing the gaps. And that takes us back to the Phillips curve, which we talked about earlier this semester. The Phillips curve shows the relationship between inflation and unemployment. And you'll recall that when the unemployment rate is high, then no one has jobs, no one's buying anything. And if we're not buying goods and services, then what happens to prices? Well, prices go down. So these are low prices when we have high unemployment. When the unemployment rate is low, then we all have jobs, we're all making money, we're all buying goods and services, and that increase in demand for all those goods and services is going to take your prices and make them higher. So the difficulty with the Keynesian monetary policy is that you can't achieve stable prices and the goal of full employment. You can't achieve those simultaneously, because if you want the unemployment rate to go down, it's going to cause prices to go up. And if you want to make prices go down, it's going to cause the unemployment rate to go up. So because these goals conflict, you can't do both. So you have to choose. Are you going to use monetary policy for stable prices, or are you going to use monetary policies for full employment? Keynesians use it to achieve full employment. Canadians use it to achieve stable prices. And we'll look at how the Canadians use monetary policy in just a moment. But before we leave the idea of the Phillips curve, let's look at some historical data. So here we have Canadian unemployment rates and inflation rates. So notice here in the 80s, we have unemployment going up and prices going down. And then in the 90s, you have unemployment rates going up and prices going down. So we can see this relationship here between the Phillips curve in the 80s and the 90s. You'll recall that in the 70s, we had stagflation. And what is stagflation? Stagflation is high unemployment and high inflation. Okay. Now, if we look at the current years, so as we look at 2017, we have entered a unique area, a unique point in time, because we now are reaching a point where we have low inflation and the unemployment rate has been falling. Okay. Now remember, full employment is 4 to 6.4%. So the question is, as the unemployment rate falls and it falls below full employment, will we reach a stage of low inflation and low unemployment? In which case, then the role of monetary policy to stimulate the economy becomes a bit problematic. So we'll have to see what happens as the unemployment rate falls. Do prices start to go up again? Or are we reaching a new era in terms of low inflation and low unemployment? So let's look at how Canadians use monetary policy. Since 1993, the primary goal of the Bank of Canada has been to keep the inflation rate between 1 and 3%. So we primarily use monetary policy, changing the money supply and changing interest rates to keep inflation between 1 and 3%. So when would a Canadian monetary policy use expansionary monetary policy or contractionary monetary policy? Well, let's think about this. So let's just create a blank page here. All right, so let's suppose that we have high inflation. Okay, so inflation rates have gotten above 3%. Well, if we have too high of inflation, here's aggregate demand, here's aggregate supply, here's the price level, and let's say that this price level is 103. So that tells us there's been 3% inflation since the base year, and we want to get that down. We need aggregate demand to increase or decrease. Well, we need aggregate demand to decrease to get those prices down. Okay, so if we have too high of inflation, if we're above 3%, we need to get aggregate demand to decrease. So if you want aggregate demand to decrease so that prices will fall, what should you do to the money supply? Increase it or decrease it? Well, if you decrease the money supply, it makes interest rates go up, which makes investment spending go down, decreases demand, makes prices go down. So if you're using Canadian policy about stable prices and we're getting inflation above 3%, so if it starts to creep up here, we need to decrease the money supply. And if our inflation rate falls below 1%, then we're going to need to increase the money supply. So primarily in Canada, we use monetary policy to keep the inflation rate between 1 and 3%. But we also use the money supply to help create a trade rate or a exchange rate that's advantageous to trade. Okay, so if we want to decrease inflation, if that was our goal, we wanted to get prices to fall, then we could use contractionary monetary policy and make the money supply go down. But what if we want to use monetary policy to stabilize the exchange rates? Okay, so let's look at the impact here. So let's suppose that as part of our monetary policy, we raise interest rates. Okay, so if interest rates all go up, then what happens to demand for Canadian dollars? Well, if I'm looking at investing in, let's say I'm living in the US, and I'm trying to find where am I going to invest my money? Am I going to buy American stocks and mutual funds, Canadians, worldwide? Where am I going to put my money? Well, when I'm looking at where I'm going to put my money to accumulate wealth, I want a higher rate of return on my money. I want to put it in a location or an investment type that'll make that money turn into a lot more money. So I'm looking for a higher rate of return. Well, if our interest rates in Canada are higher than they are in the US, then what happens is people in the US would rather invest or put their money here in Canada. So if interest rates go up, then demand for the Canadian dollar goes up. Right? If you want to invest in Canadian stocks and mutual funds and bonds, you're going to need Canadian dollars to do it. So demand for Canadian dollars increase because you want to invest here. Well, when we look at our exchange rate, we can look at our demand for Canadian dollars, and we can look at the supply of Canadian dollars out in the rest of the world. Well, if the rest of the world is demanding more Canadian dollars, then what that does to the value of the Canadian dollar try this again here, the value of the Canadian dollar, it goes up. Okay. So when we raise interest rates above other countries, demand for Canadian dollars increases and the Canadian dollar appreciates or gains value. Okay, so what do you mean by appreciate? Well, right now, the current exchange rate is 1 Canadian dollar is equal to 78 cents US. When a currency appreciates, then that Canadian dollar goes farther. So if it appreciates, it could go, for example, to 85 cents US. So the Canadian dollar has gained value. We can now get more of foreign currency and foreign goods with it. When we raise our interest rates above other countries, then there's more demand for Canadian dollars. Canadian dollar strengthens. On that note, then, if you lower your interest rate below other countries, then what happens is we have less demand for Canadian dollars. And in fact, all the Canadians want to buy other currencies, right? We'd rather put our money into other countries that are earning a higher rate of return. So what happens is there's less demand for Canadian money and more demand for other currency. And when there's an increase in demand, say, for US dollars, so we'd rather invest with the US, technical difficulties here. All right, so if there's a decrease in interest rate in Canada compared to the US, then we would rather invest in the US. So the demand for US dollars will increase. There will be less demand for Canadian dollars. And so the US dollar will appreciate. And when US dollars appreciate, our exchange rate is Canadian for US, the Canadian dollar depreciates. So when we lower our interest rates, the Canadian dollar falls. And if you look back over the last couple months, when there's been an indication that the Bank of Canada might raise interest rates, what's happened to the Canadian dollar? It strengthens, right? Because in anticipation of that higher interest rate, there's greater demand for Canadian money and the Canadian dollar appreciates. When we lower interest rates, what we see is the Canadian dollar falls in value. So we have to think about then, what is the ideal exchange rate? Ideally for Canada, the exchange rate, our preferred exchange rate, is 1 Canadian dollar equals about 90 cents US. And the reason that that is the preferred exchange rate is because we don't want the Canadian dollar to be too strong, because we sell so much of our goods to the US, and we have a lot of US tourists. So we want to be the cheaper goods, the cheaper alternative, and we want Americans to come and visit and shop here. So we need our currency to be slightly weaker than the US currency so that Americans will want to buy our stuff. We can't have it be too weak. We can't have it drop too much and have 1 Canadian dollar be worth, say, 60 cents US, because that would have a very damaging effect on Canadian households who import a lot of goods from the US and do a lot of travel within the US. So we need our Canadian dollar to be weaker than the American dollar, but not too weak as to hurt the Canadian consumer. So ideally we want to be about 1 Canadian dollar equals 90 cents US. For the last couple of years, we've been below that, and about 1 Canadian dollar equals 78 cents US is where we are now. A year or two ago, it was closer to 75 cents US. So it has increased a bit, and that's because we've raised interest rates over the last couple months. All right, so we said that Keynesians, their goal was full employment, and so they used monetary policy to close the gaps. Canadian monetary policy is used to create stable prices and to make sure we're at that ideal exchange rate. Now, the challenge that we have with the Canadian goals is that should we raise interest rates to strengthen the Canadian dollar at the expense of other policy? So if we raise interest rates, what is that going to do to investment spending, consumption spending? It's going to make them all go down because it's more expensive to borrow. So are we willing to strengthen the Canadian dollar at the expense of decreasing aggregate demand by decreasing investment spending and consumption spending within our own economy? So there is a trade-off there in terms of how important is that ideal exchange rate versus how much consumption and investment spending is happening with your economy. Now, as we look at interest rates as well, we have to be cognizant that the other thing that impacts interest rates, besides the Bank of Canada changing those rates, is our level of debt. Because what if our country has lots of debt? Well, if our country has lots of debt, well, how do you finance that? How do you do deficit spending if you already have lots of debt? Well, when you think about your own credit cards, if you have lots of debt, how do you get a credit card company to let you put more things on credit, right? They charge you a higher interest rate. So the more debt we have as an economy, it also will impact our interest rates, which will impact the Canadian dollar, as well as our ability to use monetary policy to impact the economy. All right, so we looked at Keynesian, we looked at Canadian. The last one we want to look at is monetarist monetary policy. So monetarist monetary policy said that we want to increase the money supply to grow the economy, right? We want to increase GDP. If we're not at full employment, okay, and that's because that increase in the money supply, if the velocity of money is constant, would mean that we would spend the money just as many times as we spent the other dollars, and so we would be buying more stuff and the economy would grow. Well, in order for a monetarist monetary policy to get long-term growth, their view is that we should keep interest rates as stable as possible. If people know what interest rates are going to be in the future, then they can plan ahead, and it creates a more stable economy. So we're not scared that interest rates are going to go up in the future. We're more willing to buy the house and get that second location for our business because we know that interest rates are fairly stable, they're not going to change, and so we're more likely to borrow money. So according to the monetarists, you should increase the money supply whenever there's an increase in demand for money. So here's our money supply, and here's our money demanded. If the demand for money increases, so our economy is growing, real GDP has increased, so we need more cash so we can buy more stuff, this would typically cause an increase in interest rates because the current interest rate, our quantity demanded, is more than our quantity supplied. We have a shortage of cash, drives up the interest rate. But if we increase the money supply proportional to the increase in demand, we can keep the interest rates where they're at. And that way the economy will keep growing, nice steady growth. Remember that was the goal, was steady growth. And we can achieve that steady growth because as the economy grows, so a bunch of people buy houses because the economy is doing well, and that growth will increase. More people will buy houses, more businesses will expand because we increase the money supply with the demand for money, interest rates won't change. We won't suddenly have high interest rates. That means households and businesses can no longer afford their buildings, all the loans they got. So nice, steady growth. So the idea here is that if we keep interest rates stable, not changing, then that means the economy won't have any sudden changes, right? So keep the interest rate stable by changing the money supply with the money demanded. The challenge with this, though, is that stability in interest rates can come at the expense of the rest of the economy. So we have to look at, as we increase the money supply, what's happening with the exchange rate, what's happening to the unemployment rate, what's happening to investment spending. So if primarily we're just keeping interest rates exactly where they're at, that may not be what's needed to stimulate or slow down the economy. So if interest rates stay the same, then that is not going to necessarily cause the unemployment rate to fall. We need to lower interest rates to get more businesses hiring and to get the unemployment rate down. Because if you lower interest rates, investment spending will go up. You need more people to build houses, to make capital goods, and so on. Keeping the interest rate stable also may not give you the exchange rate that you desire, right? Because when the interest rate goes up, the Canadian dollar appreciates. When the interest rate goes down, the Canadian dollar depreciates. So you lose your ability to manipulate the exchange rate or to achieve the goals of closing gaps like we see with the Keynesian if primarily you're keeping interest rates constant. So you can see the different schools of thought, the monetarists, the Canadians, the Keynesians, and you have to kind of choose what your priorities are, what the top goals are, because if you use your monetary policy to close the gaps, then that impacts your ability to impact exchange rates, for example, or to have steady prices. If you focus on steady prices, then that limits your ability to focus on steady growth, and so on. And so countries and economies have to choose which monetary policies they subscribe to, and it really comes down to what are their goals? What are they trying to achieve with their monetary policy?